More on this, we're joined by Vicky Pryce in Athens. She's the Chief Economic Advisor at the Centre for Economics and Business Research. Welcome, Vicky. So, a clear sigh of relief across European trading floors this morning as hopes rise for an end to this war with Iran. But given how fragile diplomacy can be, is the market getting a bit ahead of itself?
Well, the interesting thing is that the market has been getting ahead of itself for quite some time. In other words, we had really bad news on the oil front, real downgrades in terms of growth, and yet markets had done reasonably well across the world and also in Europe as well. In a way, sort of carried away by what was going on in the US, tech stocks and so on. They had some sort of impact across the world. But in reality, what we saw underlying all this was certainly a very substantial slowdown in growth. We just had the European Commission downgrade its forecast for this year to only 1.1% for the EU as a whole and only 0.9% for the Eurozone. And also they had put up inflation forecasts as well to 3% for 2026. So all that was not particularly good news. And if you look at what has been going on in terms of the latest PMIs, which is the purchasing Managers Index, which indicates, what's happening on the ground and what expectations also are by the private sector, we saw quite a substantial contraction indicated in the last 3 months. And that's a real issue for Europe. So all this is coming as a relief.
Vicky, which specific European sectors stand to benefit the most immediately from a potential resolution to this war in the Middle East?
Manufacturing, a really important one. If you look at car production, for example, which is really under attack, not just because of higher energy costs, but also a lot of competition from China, for example, those will benefit because electricity costs have been such an important part. High energy sectors in Germany, generally, which have had to really downsize quite considerably, and also, of course, consumer prices more generally, because input costs have gone up very significantly. For individuals, of course, possibly petrol prices, which had gone up a lot as well. But generally, it's the cost to industry, but also food, where people had been worried because of fertilizer prices being very high. But unfortunately, it will take some time for some of the disruption and the upward pressure on prices to start easing. And there is a serious concern as to whether perhaps over the next couple of months we're still going to see inflation picking up and decisions perhaps would be made on interest rates on the back of that.
Looking at a best case scenario, peace being achieved tomorrow, oil tanker traffic through the Strait of Hormuz returning to normal levels, how quickly do you expect dropping energy costs to reflect in European corporate earnings?
Well, that would be, it will take quite some time for that to have an effect, but obviously the markets have decided that things will improve. I mean, there are still issues to do with airlines. Jet fuel costs have been very high, so if any reduction there, then perhaps some of the profit forecasts will improve a little bit. I mean, although we've seen profits and margins go up substantially in the US, we haven't really seen that happening in Europe. So it will be some time, I think, before we see any real change. And maybe the way that stocks are moving right now, they're anticipating some improvement, but we do know they're all squeezed, despite support that has been given in terms of subsidies by governments to ease some of those pressures.
Do you see the European Central Bank getting the breathing room to consider rates cuts soon, or is the inflationary damage going to inhibit that?
Well, it's a really interesting question because, of course, until maybe yesterday, certainly this weekend, what we were hearing was that there could actually be an increase in interest rates from the 2% in June when the European Central Bank meets next, and there could be perhaps another 1 or 2 increases until the end of the year. That may change now because, of course, the ECB will be looking at what's going on. But there is no doubt that inflation is creeping up anyway. So we've seen that creeping up in the latest figures that we saw in the last couple of months, really. So the ECB may be tempted to say we'll raise rates a tiny amount because, after all, it has reduced rates quite significantly more than others in terms of where the levels are at present, certainly below the US, below the UK. It can afford maybe to raise them a little bit and indicate that it's serious about inflation. But I would not now think, if indeed we see this oil price decline sort of continue, that they would be raising it by more than once, perhaps. But a lot depends, of course, on what happens next. And we've had periods like this before when we thought things were going to improve considerably and then they didn't.
Certainly, that's true. Thank you so much for your analysis. Vicky Pryce, their Chief Economic Advisor at the Centre for Economics and Business Research.